The Russian economy is a classic example of this. Extremely resilient, but it's resilient because it's not performing at its maximum potential. Right? An F1 car will break down all the time because you're pushing it to its limits. A Toyota Corolla that you drive at 40 kilometers per hour will never break down because you're not.
Our management quality is exceptional. But you put the same management in a more developed market where there's structural growth opportunities, I feel that most of the time they will come across as more conservative. Because they are used to more crisis fighting or firefighting, not really structurally growing their business.
Most of the time, the reported numbers in Sri Lanka are genuine. And that is also saying something.
Hello, you're with Echelon. Now, the job of stock picking remains to take advantage of the gap between expectations and fundamentals, between a stock's price and its worth. But the job has been complicated by the shift from tangible to intangible capital. From an economy where factories, office buildings, and machinery were one to be reckoned with, to one where software, ideas, general know-how matter. To discuss this idea about this shift of how we invest, if you go back to the 1930s, there's Benjamin Graham who came up with this thesis that, find the stocks that offer fundamentally lower valuations based on their earnings or their book value. And stay in them for a long time. To asking whether this thesis applies in the modern world and how it relates to investing in Sri Lanka. Around the table with me are three fund managers who are representing the buy side, so-called, of the business. So they are managing portfolios on behalf of their clients. They are advising their clients on what to invest in. Let's start with you, Asanka, right? So we have to delineate between two concepts here. There's the concept of value that I was talking about, the stock's price versus its underlying earnings and its underlying book value, accounting concepts that, we can easily understand. Sometimes associated with this value investing is, okay, you buy and hold, right, until you unlock that value, right? So we have two concepts here, right? Put this into context around Sri Lanka, and I'm asking you to answer a big question here, but, does this work?
First of all, I think, as I was telling earlier, investing is an art. It's not an exact science. So to me, value investing is not what Benjamin Graham founded or what it was in 1960s. It's more like, what Joel Greenblatt or Howard Marks actually subscribe to now, which is essentially value investing is you buy something, you invest in a company at a substantial discount to its value. And when you look at its value, you can't look at it simply on its tangible asset value or the net asset value. You have to take into account its growth potential, because ultimately in most business, a large portion of the value is generated from future cash flow. Now, to answer your other question, does it work in Sri Lanka? Right? I think buying something lower than its actual value works in every context. So it works in Sri Lanka. But there are certain challenges countries like Sri Lanka, frontier markets, poses to a value investor. See, typically, value of a firm grows over a period of time. Now, even in developed markets, what happens is the share price over time fluctuate around that line. But in frontier markets like Sri Lanka, given the macroeconomic volatility, right, industry volatility, right, and business risks, the volatility is much sharper. Sometimes in certain instances, that overshooting of the share price can actually capture 5 years of growth, 5 years of value. And at that point, you have to exit. Let me throw some numbers which might surprise. Do you know that Cargill's bottom line has increased by 10 times since between 2008 and 9 to 2022-23? It has actually increased by 4 times between 2011 and 12 up to now. Right. But if you look at it, there are large periods over the last 15 years where the Cargill share price haven't actually generated that upside. Why is that? Because just after the war ended, the share price materially shot up, capturing growth for a few years going into the future. So Sri Lankan investors need to remember our market cycles, valuation cycles are shorter. Value investing works, but moment your price trends about the value substantially, you need to exit the position.
Sure. So, Asanka Herath is head of equities at Lynear Asset Management. It's a manager of assets on behalf of individuals, but also you manage a lot of portfolio assets. So, welcome to the conversation. And I'm switching to Vindhya. Vindhya Jayasekera is the Chief Investment Officer at NDB Wealth Management. Vindhya, welcome. And here's the thing, let's put some base context to what we are discussing. You often benchmark markets performance. Fixed income is a good benchmark to use for equity. There's one benchmark to use. Has Sri Lankan stocks in general delivered?
So Shamindra, actually we've done this study we've used a lot of data points. Actually, I've looked at over the last 10 years on a buy and hold strategy, as Asanka was saying, how our market has performed. And looking at like roughly 6,000 data points, the average market performance on a 10-year period is about 14%, somewhere in that range. Similarly, if you look at the average treasury bill rate, the average treasury bill rate has been somewhere in the range of 11%. So the premium between the 14% to the 11% doesn't really seem enough. And even if you look at how many times, for example, if you think about only about 20% of the time, the market has actually given returns over 20% over a 10-year period. So in that sense, I take the point that Asanka makes. Value investing is actually a strategy that has been advocated. But for countries like Sri Lanka, like he mentioned, where you see very pronounced cycles, you really have to take action in between. So it might be that it's not that value investing doesn't work, but I think the Sri Lankan context you have to take separately as well.
Right. Kanishke Mannakkara is the chairman of Cal Investments. He's also the chief operations officer of Cal, the investment banking group, right? But you're here as more as the chairman of Cal Investments, Kanishke, and investing in the index here in Sri Lanka hasn't in the past been a good strategy.
Of course, we are colored by our past. So it's been the returns since the end of the war haven't truly materialized. It's been maybe a touch below inflation. Past and the future are not the same. That said, I agree with both Vindhya and Asanka. Maybe 10 years is too long horizon for Sri Lanka, and you need to be thinking in terms of shorter cycles. Within those short cycles, I do believe there's a lot of upside to be gained. I believe the best strategy to make money through investment in Sri Lanka is a multi-asset class strategy, where based on how the macro moves, you're nimble to move between asset classes. And within that also, I think a good holding period is maybe 18 months. Now, from my observation of the Colombo stock market, I think that's a longer period than many people will hold their shares for. I think there is and so to address your audience, maybe it's important to remember that trading too frequently is expensive here, and can be can be destructive. Every time you buy or sell shares, you spend a little over 1% of that value on, so a round trip costs you 2% plus. So you need to bear that in mind when you're trading, and the number of times you churn your portfolio. In my opinion, 12 to 24 month strategy has worked. Value investing is a funny concept, because concept of value, you're talking about historic, and I always believe in looking at the future. So I think if you can identify value in the future, there's a lot of upside to be unlocked. But going just based on past performance, I don't think is the right course of action.
So we're discussing two things. We are discussing the concept of value investing, and also related to that is a strategy of buy and hold that is not necessarily closely linked to value, but buy and hold fundamentally good stocks. Has that worked in the past? Asanka, coming to you, if you sort of try to sort of go between these two, right, of value investing versus buy and hold. Now, Kanishke is suggesting, hey, surely you'll buy based on value, but you'll re-look at your portfolio 12 to 18 months, right, based on expected value of future cash flows. Maybe Kanishke, if an investor can do that, right?
I think, frankly, next quarter's earnings. Be simple, understand what the market reacts to, and invest to that.
What's your take on this?
So, I want to be very clear. I don't believe in buy and hold,
right,
where you're holding beyond its value. And I think on that, all three of us are on the same page, right? Because value investing is not buy and hold, right? So, after you buy into a company, once a price trends above the value, you have to exit it, right? Because I'm just giving another point. In 2011 January was when the market corrected after the post-market run, post end of the war run. And by that time, some of the companies with some of the best business models, some of the sharpest minds, best brands were trading at around 15 to 20 times trailing earnings, right? So essentially at that point, the prices have captured earnings growth which is available for another couple of years. And also we were facing currency depreciation. We were looking at interest rate hikes, which makes fixed income attractive. So there's anyway naturally going to fund outflow. So so the valuations were expensive. And at that point, if you said, look, I like this company, this business can grow over the years, I'm going to hold on to it, that would mean that your opportunity cost will be higher. That strategy would not have worked. Unless, of course, you are more like a strategic investor. You have decided to take a 10-year view on Sri Lanka. You're going to hold those equities for 10 years or 20 years and take that view. It would not have worked. So that's a point I want to make it clear.
How do you sort of make this distinction between being strategic investor? There's lots of people, there's lots of investors who hold big positions in corporates for a very long time. Not even, far longer than 10 years also. It looks like it's working. How do you make that distinction?
So there are strategic investors and then there are long-term investors. I should have made the distinction in my earlier comment. Strategic investors are ones who take control and who want to drive the strategy of the business, right? Given what expertise they can bring or the synergies with other businesses, they believe they can create an additional value rest of us can't see. Right? You can get a long-term investors who, whatever reasons, there can be reasons at a very high portfolio level have decided we are going to take exposure to 20 frontier markets, right? And we are going to hold it for 10 years or 20 years because one of those 20 in a 10-year horizon or 20-year horizon can be the next Vietnam, right? Then once you make that allocation call at a high level, you are committed to it. So there can be long-term investors like that. But other than for those two very specific reasons, I don't think a buy and hold strategy works.
I agree with Asanka, and essentially you're talking about not following the herd.
Yes.
So when market frenzy picks up and valuations go beyond the point of sustainability, it makes sense to sell. Which is why I think that's what gives us a job. Is that it's important to buy at the right price. It's also important to sell at the right price, and you can't just be blind to that.
Are there idiosyncrasies about Sri Lanka that make this strategy you're discussing more valid in Sri Lanka or less valid, do you think?
I think yes. So the more perfect a market is, the less opportunity there is for people like us to make a difference. And then we are in a deeply imperfect market. So the market reaction times are slow, market information filters through slowly. So for all those reasons, somebody who can take an educated guess about the future is at a distinct advantage.
Okay, so tell me why you suggest here the market reactions are slow and information takes a long time to filter out.
Because of low liquidity, low level of sophistication amongst investors, unavailability of capital, the size of our capital market, all of these things.
Shavendra, if I may add, I think your question was, are there idiosyncrasies about Sri Lanka which makes buy and hold strategy that much more riskier? That was your question.
Okay.
I agree with Kanishke said. I just want to add from a different perspective also. Sri Lanka is such a small economy, right? However much we claim to be, our innovation is very small. Our global integration is poor. Compare with a Vietnam or a Singapore or a US or any of the developed markets, those companies are globally integrated. When the US economy slows down, they can actually expand overseas. Their brands are stronger, right? Innovation is great. So what it means is that those companies listed in those markets have more structural opportunities to grow. Sri Lanka doesn't have that. So, short, sharp market movement in a country like Sri Lanka can easily overrun the value of the businesses. While in a country like US, those structural growth opportunities ensure that value can grow at a faster pace in those businesses than in a country like Sri Lanka.
Yeah, because actually, if you look at our market, you're looking at the breadth and the depth of the market is really not enough. I mean, we have 290 companies listed in our market, and the average turnovers have just started to really pick up. The last 5-10 years, we haven't really seen that type of turnover levels as well. So this is a market where substantial investments coming in itself can drive up the price. And at that point, you should think about whether the price has come to the value that you think is fair and that you want to exit.
So to your point, Asanka, so Sri Lankan companies are also far less sophisticated than obviously ones from the US or Singapore.
I hope the managements don't stop taking my calls now. Right.
Because you're suggesting the sort of multiple they bring to the table in terms of intangibles here is likely lower than obviously the US or these big European companies. Your job is easier in that sense because there is less intangible potential to consider.
So let me answer the two questions. We can't generalize by saying that in all aspects our intangible value of some of our businesses are lower. If I compare with some of the frontier markets, and Kanishke might agree, because they have business in Bangladesh, etc., you feel in certain sectors our management capability is almost comparable to developed markets.
Okay.
And that's what actually keeps driving some of our businesses in the current context, especially take it the banking sector. So that is a point to consider. But here's the other catch, right? If you take that high level view that, there are businesses, our businesses are almost invariable, we struggle to grow structurally, you can miss out on those one or two companies which will actually grow very structurally, right? So that is something you want to be mindful of, right? Sometimes, that multi-bagger, right, which have generated alpha over the last 5 to 10 years can be that company which has, simply because of the intangible, that has grown over the last 10 years and given alpha.
I agree. And that is also true from sometimes deep discounting. So I'm going back into this value. You can't, I haven't seen an opportunity to value invest across an index. But certainly we've seen several examples where there was deep discounting because of perceptions. Haley's 18 or 24 months ago was a prime example of this. Maybe it was, late 2020. The market capitalization was 16 billion rupees for Haley's. And I saw a similar case with Aitken Spence, both positions that we took, that both companies that we took aggressive positions in. Maybe Dialogue is an example of that today. Where you have this deep discounting of certain companies and there is an opportunity there. But I don't know whether that's a value investment strategy or simply, spotting market mispricing. And I think asset mispricing happens a lot in our market and there's a lot of opportunity to make money from that. And that's what we focus.
It is part of the value investment strategy as well to look at the asset mispricing as well, right? So I think that is part of where we can add value in looking at assets that have been mispriced or shares that have been mispriced to look at anything that is at an undervalued position to buy.
Is it generally true that the Sri Lankan market is not so good at dealing with intangibles or dealing with companies that have a higher share of intangible? Would you think that is a broadly true thesis?
I think it's not just intangibles because market is imperfect, market is inefficient. Large part of that is that our market is under research, right? Even if you consider the not just in terms of breadth, in terms of depth. So our market cannot actually, I would say, compared to more developed markets, can't assess value. And therefore, you can end up under-assessing the growth potential or over-assessing the growth potential of a company, right?
The danger is that it'll never realize this
So
mispricing.
that's the interesting part, right? So which is what I always urge, and we say that our philosophy is value with catalyst. You want to buy into a company which is cheap, but you kind of need to estimate, when the catalyst could be. Catalyst could be the next quarter's earnings, dividends, or a M&A, etc.
Sure. Got it. Value with catalyst. That makes a lot of sense. Kanishke, you talked about the unsophistication of Sri Lanka's market, and you're seeing this all the time. It is reacting to the reported quarter's earnings significantly, right? Almost like as if nobody expected these earnings numbers to come true, right? Is this a peculiarity now because there is so little participation, or has this been borne out in the past? That the market
it was even worse in the past, in my opinion. So I remember a time, maybe 2006, 7, 8, where not people didn't look at price earnings ratios, and then they just acted on simply rumors. Then there was this great move towards looking at PEs, and now we are looking at maybe 1 quarter, and you get market runs based on future earnings also. Expo was a classic example of that happening. So I would argue our market is slowly getting more sophisticated, but there's a long way to go. And that's where professional investors can hopefully outperform the market over the long run still, because there is so much headroom.
So there is so much opportunity to find value here. And the way and the only thing you need to watch out for is that there is some catalyst that will then unlock that value for you, because otherwise the market will never realize that value, right? Vindhya, how do you approach this?
So I think you have to look out for, like Asanka was saying, you have to look out for what is the next event. I mean, when you think about a company that's undervalued, why are you thinking it's undervalued? It would be maybe on earnings performance, or it would be on some event that you think that is happening in the company. So there is a certain level of forecasting that you would do, and what you are looking at is, will the market realize what you have forecasted? At what point will the market realize it?
And as fund managers, you carry that burden. You will not benefit. Your position will not work out unless the market in general realizes what's
sure,
happening.
But I think, like Kanishke was saying, market is getting much more sophisticated. You're looking at, you're acting on information much more faster. It's a very different market to what we had 2009-10 post-war. So this is probably our vintage. It's a very different market to where it was 20 years before that as well. So everybody is getting smarter. Everybody is reacting to information much faster. There's a long way to go, but certainly things are improving.
When you talk about catalytic events, right, are you referring, Asanka, in terms of that company in question, or are you talking about catalytic events as far as the economy or the market in general is concerned?
No, I think when it comes to value investing, when you're talking about catalytic events, it's primarily company related, but it can be industry related also. Now, I'll give a classic example, right? I think if you go back 7 to 8 years, I think Haley's Fabric went through a very tough time making deep losses, right? And they were trying to develop this fairly unique product portfolio, which they were hoping that when it succeeds will bring them sharp volume growth and the margins. So you try to assess the value of that intangible capital, what they're trying to do, which is not really quantifiable. And then you build a position. And when they start reporting few quarters of black which means profit, then that is like the ideal catalytic event company related. But if you look at more recent events, if you look at the banking sector, I think most of us in this room believe banks were undervalued. And there was greater clarity on the domestic debt restructure proposal, the entire industry rallied. So it can be, I would say, mostly company related, but it sometimes can be industry related.
Look at the context here, and we in Sri Lanka have had a lot of company managers in Sri Lanka have had a lot to deal with over the last decade or more. There was the war, and then we really didn't realize
Last
the
40 years, Shamindra.
last 40 years possibly, right?
Yeah, war, JVP. So we get these issues every 3 to 4 years.
So is it your thinking that there is intangible value in the know-how within Sri Lankan companies about navigating crises? Have they done an exceptionally good job navigating crises? And is that capability or is that value likely to be unlocked? Is there underlying value there in the first place?
I wouldn't overemphasize that as a point of strategic difference. The Russian economy is a classic example of this. Extremely resilient, but it's resilient because it's not performing at its maximum potential. Right? An F1 car will break down all the time because you're pushing it to its limits. A Toyota Corolla that you drive at 40 kilometers per hour will never break down because you're not. So just because we are resilient doesn't mean we are performing. I love some of the companies, in Sri Lanka, and I believe very strongly in them, but that's not my reason to invest.
Just to add to that, I think compared to the frontier markets, which frequently face crises, our management is, I would say, our management quality is exceptional. But you put the same management in a more developed market where there's structural growth opportunities, I feel that most of the time they will come across as more conservative. Because they are used to more crisis fighting or firefighting, not really structurally growing their businesses.
So
if I may add, where I think we stand out amongst other frontiers is in terms of the authenticity of the numbers. I believe that most of the time, what is reported, not 100% of the time, but most of the time, the reported numbers in Sri Lanka are genuine, and that is also saying something for this brand of.
So are we as a market at an inflection point? Because intangible value underlying in companies, whether that be know-how, brands, IP, management quality, etc., will that matter more in the future than it has mattered in the last 10, 20 years? Is this a point at which we diverge as a country, as a market?
That's a difficult question, but I think if you look at the Sri Lankan market and in terms of branding, I mean, who are you trying to capture? You're looking at a 21 million population. Our population size itself might not be enough to capture that type of intangible, versus if you're looking at expanding out of Sri Lanka and you're catering to a much larger market, there might be something to additionally look at in that sense.
Are the ground rules slightly adjusting here, Kanishke?
I'm not yet convinced. I don't see that as a catalyst that I consider imminent. Even the companies that are expanding overseas, we are not giving them a multiple. Okay, with the exception of Expo, let's say take JAT. It's trading at a very poor multiple, even though they have genuine potential to go outside. So I don't think we're necessarily valuing it in that way. I'm also not convinced that this will be the inflection point. I do think valuations are at an inflection point in terms of growth, because there's so much to be unlocked, and we discussed that in the last session. But in my opinion, this is not it.
I think I tend to agree with Kanishke. I think it's too early to call it an inflection point or not.
In terms of intangibles.
Intangibles. But the key thing is, you can't value a business just by looking at the tangibles. You have to look at the intangibles also, and take into consideration both the tangible and intangible values of most of the listed equities in the market is materially undervalued. I think that's something I can say with certainty. It's too early to call whether the market will give a greater weightage to intangible values going forward.
If I can persist on that, right? Okay, so one aspect is, are we at a divergent point on intangibles, right? But take a broader view, what about investing and holding for the next 10 years will be different to what you have done in the last 10. Now, Kanishke, you said, okay, 12 to 18 months in the future is a period around which you have to be, sharp-eyed about, right? How does that compare with the past? Is it different? Are your holding periods likely to shrink as a result of the market's sophistication?
The investment period doesn't shrink with the market sophistication. I would argue all the things will move faster. My investment horizon will lengthen with stability, with local stability. So if we see some of the reforms that have been implemented, if we see them coming through to fruition, independence of the central bank, etc., then hopefully we will have greater stability, and with that we might increase our investment horizon, from 18 months to 36 months maybe.
If I can add to that, I think right at the beginning what we were mentioning, you see a lot of volatility in Sri Lanka. We've seen interest rates at 4% in 2020 and then going up to 30% 2 years later. Right? So that type of volatility, even 2019, we experienced the same type of volatility. This is the reason why we see so much intensity in terms of the value being realized way before that earnings potential. So in that sense, that's why sometimes our horizons are short. Although we take a long-term view of the company and we invest, sometimes we can sell the share off within that 12 to 18-month horizon, because a lot of what we have factored in gets now factored into the share price. But Kanishke correctly put it, as you become more stable, if we are able to go through our political reforms, go through our economic reforms, and then I think that fluctuations will reduce. So your holding periods will increase.
Just be elaborating what both of them actually said. The reforms that is happening now, if sustainably implemented, will address some of the long-standing structural issues Sri Lanka has faced. Twin deficit. If twin deficit get addressed, that means our interest rates can remain reasonably low for a protracted period of times. Our currency will be stable, both of which will mean for both local and foreign investors, Sri Lankan equities will be attractive. Things like FDIs will come to Sri Lanka in a substantial way, and also if we push through with trade agreements, the market opportunities for Sri Lankan listed companies will be bigger. So structural opportunities will be bigger. I think that's what all of us are saying. Right now, from what we see, it's about 12 to 18 months, and beyond that, investment period can lengthen based on whether these reforms are irreversibly implemented. We hope, we all stay in hope that it will happen.
Great conversation. I will ask each of you to put any final thoughts on the table. Can I start with you, Kanishke?
I think we've had a good conversation around value. As investment managers, we are trying to unlock value. The key question is unlocking it effectively to actually make money for our clients, which is what we're trying to do. And in my opinion, that's about looking at the future, not the past. Sri Lanka is evolving. And I think if you take the very long term, we have evolved in a positive direction despite very obvious blips. We have evolved in a positive direction, and I remain optimistic about the future for our country. I think we are taking certain right steps. The crisis has taught us that we need to make certain reforms, and I think those reforms have started from institutional independence to trade liberalization, which I think is critical. Removing protectionism for Sri Lankan firms will force them to compete and eventually make our business sector and our business community stronger and globally more competitive. So we sincerely hope stuff like that will happen. Greater stability will come in, and then our investment horizons will be long and valuations will be higher. In the very short term, we are thinking purely from an investment perspective over the next 12 to 18 months. We think there is upside even without all of that stuff. All of that will be the icing on the cake.
Vindhya, to you.
So I think I started the conversation saying that when you look at the last 10 years, you haven't seen our share market give stellar returns. 14% type of returns is what we have seen. But it doesn't mean that we are going to go and invest in the entire share market. So the entire share market won't give us the returns because of breadth, because of depth, liquidity, all these concerns. But you pick and choose the right stocks, which is what we talk about in value investing. I think still there is a lot of potential that investors can gain, and especially if you see the right reforms being put in, there is a lot more potential in terms of the stocks to hold it for longer tenors and realize higher returns, which we will see in line with probably more emerging markets and developed markets.
At the risk of repeating, irrespective of all the long-term reforms, we feel, I think, equities can generate substantial return over the next 12 to 18 months. Second things on a personal note, I'm actually hopeful that some of these reforms will get implemented. Right? As an example, petroleum sector liberalization is probably 40-50-year-old discussion, and it has got implemented because crisis pushes people to do things they never wanted to do. And today, if you really look at it, more so than any point in our recent history, there's political capital in support of reducing government expenditure, rationalizing the government institutions and privatization. So I remain hopeful that there's a great opportunity for sustainable reforms, and I think that may happen, and that might actually means that our equity run can be longer.
Asanka, Herath, Vindhya, Jayasekera, Kanishke, Mannakkara, thank you. That was a fantastic conversation.
Thanks for having us.